Welcome back, students who are taking financial accounting. This here is the Chapter 2, Analyzing and Recording Business Transactions set of theory videos for the chapter. In the previous video, we just covered quickly the introduction, and we covered, what about Chapter 1 in other videos. So in this video, we're going to pick up with the double entry bookkeeping. But before I go there, I know that you're probably tired of listening to me, say this, but you're supposed to study the textbook. I mean, that's your primary method of learning the material and doing the assigned homework problems. These supplemental videos that I'm creating are just to expand upon, bring additional insight into, and present the information in a different manner so that things might click if you're not getting it from the textbook. Okay. The videos are not meant to replace what's in the textbook, meaning you're not going to get all the information. I mean, this is not high school where I have to repeat all of the information because I need to push students through a classroom. Okay, so I'm not, I'm covering what's pertinent, but I mean, like here, I'm not going to go over a lot of the definitions. All right, I'm not going to cover every aspect that's in the textbook. I mean, why should I reread the textbook? So in these videos, I'm presenting stuff, in a different manner. Hopefully it'll click. I'll provide insight. I'll even explain how I go about it, which I found, most useful for me after 30 years of doing this. All right. So if you study the textbook and you're struggling with it, and now you're watching the videos, hopefully you'll get it. And if you're not following something in the videos, I mean, I realize I'm monotone. I talk fast and I scribble a lot. I don't write very neat and things like that, but that's because I'm not making these, professional videos. These are just brain dumping videos, okay? And with that said, you can pause the video, and that's the beauty of videos is you can go back and watch them again and try to, pick up where you left off and be able to, get the information. And then if you still don't understand it, instructors are available. I mean, take advantage of that. If you don't get it, feel free to contact an instructor. Okay. So with that said, let's move on to the topic double entry accounting, or what I like to call double entry bookkeeping. All right. The thing about double entry bookkeeping is there's two, as I constantly teach this, I come across what I like to call two inviolate laws of accounting. One is your debits must equal your credits, and the other is your assets must equal your liabilities plus your equity. Okay, if your debits don't equal your credits, you made a mistake somewhere and it needs to be corrected. And if your debits don't equal your credits, then your accounting equation is not going to balance. Now your debits could equal your credits and you can still have your accounting equation not in balance. But the issues with these are that they're not judgment calls. It's not decision making. These are a mechanical thing. Meaning if I make, as an example, if I make a journal entry, right, my debit, let's say is for $20, then my credit has to be for $20. Debits have to equal the credits. Okay. And if that's a journal entry and I'm posting it to ledger accounts, right, then all I'm doing is just rearranging the information. I'm just moving it. Well, if I'm moving it, I shouldn't be making a mistake doing a mechanical thing. In this account over here, I have a debit for 20. And in this account over here, I have a credit for 20. All I did was just rearrange the information. So it should still say the same. And then when I'm calculating balances, meaning I'm adding up the information in a particular account, well, if I'm doing the math right, my debits still should equal my credits. And if this is all true, right, then when I go to create my financial statements should be in balance, right? Now, if you make a mistake somewhere, you have to go back and find it, all right? And the reason why you have to do that is because if you don't, and all you do is just fudge a number, all right, in order to get the debits to equal the credits or to get the accounting equation to balance, then what you're doing is cooking the books. The person who invented double entry bookkeeping, double entry accounting, it was an ingenious method, okay? You can make a mistake, all right? Let's say rent expense, right? Let's say you're going to debit rent expense, and let's say it's supposed to be $1,100, right? And but for whatever reason, you decide, you make the entry for $1,010, right? So even though the amount is wrong, this debit equals this credit, okay? And your decision making was what accounts to use, okay? But the mechanical side, whether that's right or wrong, should always work, all right? And so there's no decision making when debits don't equal credits, and there's no decision making when you're looking at your accounting equation to balance, because it's a mechanical process. Even though that number is wrong, the book should still be balanced. Now, if for some reason, and this is where cooking of the books comes in, well, let's say I make the debit what it's supposed to be for $1,100, okay, but I make an entry that has 1,100 and my cash is only 1,010. That means I'm $90 off, okay? Who got that $90? You can't hide it. That's the whole idea behind double entry bookkeeping. You cannot hide the embezzlement, right? If you can do it, right? But eventually it's going to be found, all right? And this has been proved all along, with companies like Qualcomm and Enron years ago, okay? So um, that's what double entry bookkeeping is about. Now, to work with double entry bookkeeping, it's not a matter of memorizing things. It's about understanding. And the understanding is a relationship, okay? It's a relationship between the categories of accounts, the normal balance, and the debits and credits. Okay, so for our categories of accounts, if you read the book, you have 5 accounts, 5 categories: assets, liabilities, equities, revenues, and expenses. Okay, and in the chapter 1 videos, the theory videos, I covered the concept of a normal balance. All right. Well, before I go there, the definition of an asset is something you own, OWN. Okay. Now, realize that when you're looking in the book, things like equipment, computers, furniture, supplies, these are all common, all right, types of assets, building, land. But realize that, what you see in the book is not necessarily the end-all be-all of everything, okay? You know, maybe I have a company and I buy a dredge, okay? Well, depending upon the company, I might put that dredge into the equipment, okay? But maybe I might have a separate account called a dredge account, depending upon the company, all right? Maybe I install piping, underground, all right? And, my equipment account, it doesn't necessarily, having that one account name doesn't necessarily fit for all the different types of equipment that I have, okay? So I might buy a dredge and I might have one separate account called a dredge. And even though you're not going to see in the financial accounting book, the word dredge, it could be, it's equipment that I own, all right? So that's what I mean by understanding concepts and applying it to the situation. You can't, you start out with, the most common things like these accounts, but you're always going to have, anomalies. You're going to have something that's different, something that's never found in a book, okay? That applies to your business or some other business that you have to deal with, right? Like in the case of the dredge. So, utilize what's in the book, but understand why you're utilizing what's in the book, An asset is something you own, and if you own a dredge, that dredge could be, a general ledger account name, All right, but you're not, like I said, you're not going to see that in this book. Okay, doesn't mean that it doesn't exist. Liabilities, is something you owe, right? Now, when I talk about expenses, I'm going to revisit liabilities. Liability is something you owe. In other words, if you buy something on account, on credit from a store, you're going to owe them that. That's why it's an accounts payable. Or let's say you have a mortgage, right? I mean, obviously, if you paid off the whole mortgage, you wouldn't owe them anything. But if you're making monthly payments on your mortgage, well, that's a mortgage payable, right? The word payable denotes, a liability, something you owe, right? Equity is the investment in the business. Okay, and it's also, shows the net worth in the business, meaning if we close the business right now, you sell off your assets and to pay your liabilities. And anything you have left over then goes to equity. Okay, so that's the net worth of the business. Right? So when your accounting equation balances assets equals liabilities plus equity, okay, yeah, your net worth, is whatever's on the books. But realize that when you close a business, your net worth can actually be different from what you have on your books, because let's say you have assets and you book let's say you have an automobile and you book it for 40,000 when it's new because you buy it new. Well, yes, you have accumulated depreciation, and that's a whole other concept, but you depreciate that. That doesn't necessarily mean, let's say you depreciated $10,000. So your books show that it's worth 30. That doesn't necessarily mean you're going to be able to sell the automobile for 30. Okay, that's what's on your books. But your equity, your net worth can be different when you end up selling the business. All right, revenues, assets, liabilities, and equity are on the balance sheet, which in the previous chapter, we talked about that. And revenues and expenses are on your income statement. And revenues are your sales, and expenses is your outflow, what you spend to operate the business. Revenues and expenses are about the operation of the business, right? You're in business to make money, so you're going to either perform a service or provide a product, and those are sales. And what you spend in order to be able to make those sales is called expenses. And that brings us to an accounting principle called the matching principle. Right? The matching principle says we have to match up our expenses with our sales. Okay, and the way to think about this is, you have 30 days in a month, right? And in a month, whatever month that is. And let's say you do payroll on the 7th and the 21st. Well, between the 21st and the 30th, you have 9 days where people are working that they haven't gotten the money for, okay? Using the matching principle, we have to account for those 9 days to keep it in the same accounting period where we have 30 days worth of sales, right? Because for those 9 days, we're still making sales, but yet we're not matching up that payroll expense with it, right? And that's what the matching principle means. We have to match our expenses with our revenues. Right. Now, that leads us to the next concept here, the normal balance. Now, I like to use the word plus to mean normal balance, to represent the normal balance. It doesn't mean increase and it doesn't mean decrease, okay? Well, it does mean increase, but the issue here is the definition of a normal balance is what increases that category of accounts. Okay, so what are we looking at here? Well, we're talking about what increases the category, right? So these are our categories, right? These are our categories. and we know they increase, but the question is what increases them? Okay. What increases them is either a debit or a credit. Okay. So that brings us to these illustrations that you have in your textbook. Okay. Now, people think of debits and credits, they have a tendency to think of a debit as a plus and a credit as a minus because that's the way their checkbook works. Okay. And when it comes to accounting, you're going to find that you can't think from that perspective. Okay. Debits and credits, the definition of a debit is what's on the left. It's just on the left. And the definition of a credit is what's on the right. Okay. So now, what does that mean? Okay. Here we have this normal balance, which means, is what increases the category, and the what is the debit or credit. So what you're seeing here is you're seeing a relationship between the categories of accounts, the normal balance, and whether they're debits and credits. You can't look at one in isolation from the other. You have to look at all three at the same time, all right, in order to be able to put the information there correct, right? And that's what makes it so difficult for a lot of people because they try to memorize things instead of understand them. Right? And if you memorize, you're always going to have a new situation that you've never seen before, or you're not going to find it in the book. And then what do? Right? Because you didn't understand the underlying concept. Right? So with that said, we're talking about double entry bookkeeping. And notice here it says debit, what's on the left. And notice credit, what's on the right. And also notice that the way this is presented is like this. And that's called a T account, even though it's not written in the book, okay, as such. When you draw a T like this, it's called a T account, and that's a tool that we use in order to be able to understand what we're looking at on the set of books. I mean, even CPAs who've been been in a CPA for 20 years still use T accounts as a tool when they don't understand something. So as a beginner, someone first looking at accounting, you shouldn't be embarrassed to be using T accounts. And one of our videos is going to cover that. Okay, cover the use of T accounts. Okay. But what we have here is we have debits are on the left and credits on the right. And notice right here, we have the accounting equation. Assets is equal to liabilities plus equity. Okay. Well, what I want you to do, when I'm talking to a student on the phone, what I tell them is, and I'm going to write it all out here, hopefully in the next couple of minutes. Actually, no, I'm going to try to finish it off here. I have them write the accounting equation. And then I have them draw a line underneath it, and where the equal sign is, I draw a line down the side. And notice what I just did. I created a great big T, right? T account. It's just a tool, right? And the definition of a debit is what's on the left. Well, what's on the left-hand side of the equal sign, right? On the left, and this is on the right, right? Well, what's on the left? Assets. And what's on the right? Liabilities and equity. So what I'm looking at here is the normal balance of an asset, and remember I'm using the plus as the symbol for a normal balance. The normal balance for an asset is a debit, because why? Debits are on the left, okay? Which means I increase the assets on the debit side, right? What's on the right of the equal sign? Credit. Well, I have the plus signs for the normal balance, and what's on the right-hand side of the equal sign? A credit. Well, that means my liabilities increase on the credit side, and my equity increases on the credit side. Okay. And remember, our debits have to equal our credits. So if I have 10 for an asset, then regardless of whether it's a liability or equity, I have to have 10 on the right-hand side of the equal sign, because why? Debits have to equal the credits, right? Now, here's the thing, right? why debits don't equal plus and credits don't equal minus. Notice that for an asset, I'm going to have an increase on the debit side. But for a liability or an equity account, a debit actually decreases. Why? It's the opposite, right? I said the normal balance of a liability is a credit. Well, and that we increase the liability on the credit side, which means we decrease the liability on the debit side. So in one situation, I have a debit where it increases, but in another situation, I have a debit meaning a decrease. And that's why you can't say a debit is a plus or an increase and a credit is a minus or a decrease, because it all depends upon this relationship between the categories of accounts, the normal balance, and whether it's a debit or credit. And so what we have here is a visual representation of this for those who want to memorize. I mean, you can sit here and go, okay, here's underneath the assets, and I see a debit here, which is a plus, and I see a credit, which is a minus. So if I'm looking at an asset and I'm increasing it on, it's increasing, I would debit it. And if I'm looking at, let's say I'm paying out cash to pay rent, well, that means I'm decreasing my cash, so it would be a credit, right? And I can look under liabilities and do the same thing. Well, if my liability was increasing, like I just bought something on account, right? So it's increasing here, right? That means I would credit it. But when I'm paying off that bill, right, my liability is decreasing, so I would debit it, all right? And then for stockholders' equity, it depends upon the account. Now, notice here, we're talking about the expanded accounting equation. And if you were watching the videos and doing the homework problems from Chapter 1, you saw that for stockholders' equity, we look at it in terms of common stock plus retained earnings. And as part of retained earnings, we have our revenues, less expenses, less dividends. Okay, so what they're doing here for the stockholders' equity, you can't just say for stockholders' equity we have a debit means decrease and a credit means increase. All right, like I'm talking about up here. And the reason for that is because when we consider revenues, see the debit is we're decreasing a revenue on the debit side, but if it was an expense, we're increasing it on the debit side. So it all depends upon what kind of account it is. And remember, revenues and expenses are categories of accounts. Dividends, retained earnings, and common stock are actually general ledger accounts. They're not categories of accounts. So, if you think in terms of what I presented here and understanding the concepts, right? If you think in terms of this, okay, keep in mind that revenues, the normal balance is a credit, and for your expenses, the normal balance is a debit, okay? And when you remember, this is on the income statement, whereas the accounting equation is on the balance sheet. If we take the revenues less the expenses, that gives us a profit or loss. Well, now that you know that the revenues increase on the credit side, the normal balance of a revenue is a credit, and the normal balance of an expense is a debit, as long as you understand these ideas, these concepts, you're going to think about the category of account first. You're not going to think about the general ledger account, okay? And you look at the category first, decide whether you're using it as a debit or credit, and then find your ledger account. But like I said, here, they're trying to present the information as something for you to look at and follow exactly. But you're going to run into problems when you hit expenses versus revenues, because you're going to get confused as to whether you're increasing or decreasing your stockholders' equity, right? I mean, you can use it if you want, but I kind of suggest that you don't, all right? So with all of that said, okay, that is double entry bookkeeping. And notice that before I finish this video, if I have revenues of say 10,000 and expenses of say 7,000, I have a profit of 3,000. 10,000 in revenues less 7,000 in expenses gives me a profit of 3,000. But notice that this here 10,000 is a credit and this 7,000 is a debit. When I subtract the two, I end up with a $3,000 profit. That profit is a credit. Why? Because the 10,000 is a credit. So this profit of 3,000, when we close it out, and we'll see this in later, and then later in the book in the next chapter, I believe, that gets closed out to our equity. So if I have $3,000 as a credit, that increases my equity here, all right, which is also a credit. So it falls into place in order to keep my accounting equation in balance, right? Why did I bring this up? Well, if we make a journal entry and we affect assets, liabilities, and equity, right, then our accounting equation stays in balance. But as soon as I use an asset account, for example, and I use a revenue account because I made a sale, then all of a sudden my accounting equation isn't in balance. Let's say this is 10, and so my debit is a 10 and my credit is a 10. Well, look at the accounting equation. 10 equals 0 plus 0. It's out of balance. Okay, so at the end of the accounting period, we have to bring this back into balance. And that's why I'm looking at this saying, oh, this $3,000 credit would then end up here in my equity, which ends up bringing my accounting equation back into balance. Okay, so that's double entry bookkeeping. It forces you to make sure that debits equal credits and your accounting equation stays in balance, and that there's no cooking of the books going on. But also here, I've presented a lot of information, a lot of theory that you've seen before in the previous chapter in those intro to accounting and bookkeeping videos. But the thing I'm trying to stress the most here is that this here is all a relationship, okay? You can't look at the normal balance without thinking debits and credits, and you can't determine the debit or credit unless you're thinking about the category of account. Okay, and that's what makes double entry bookkeeping, double entry accounting work, because debits have to equal the credits and the accounting equation has to stay in balance. Okay, so with that said, I will watch the video again if you don't understand something, and feel free to contact an instructor if you still don't understand it. And in the next video, we'll pick up with how to make a journal entry, which is different from, my way of doing it is different from what's in the book.